March 13th, 2024. I think days like this, it's really important to wait for follow through. We had a really tight range today in general, and we had a really, really tight range on the opening range. And I just think it's really important to wait for follow through on these days because when it starts to do this, especially, in here, you really don't want to be trading. There was a couple of okay trades like 18 and 23, but it's still really difficult to do anything. We ended up having essentially a measured move down of this. It didn't really matter, but that's just the target that 72 ended up finding was the measured move down of the trading range. And the trading range is normally the measured move of the trading range is usually going to be a target. On the daily chart, something that you got to think about, which is really important. Um, when you look at the daily chart, you should look at it every morning. I usually do. And you should try and imagine what you think the next bar is going to be. So imagine, what are the possibilities here? After you see a bar like this and then a bar like this, what usually ends up happening? Do you think there are buyers above here or sellers above here? There are probably sellers not too far above. We might have to test the all-time high first, but there are probably sellers somewhere up here. So if we start to get a breakout for the bulls above yesterday's high, or tomorrow, let's say we, assuming no gap, you start to get a breakout above the high, you should, want it to be a strong breakout. It needs to be really strong and prove it to you a little bit more, since it's more likely that there are sellers up here than there are buyers. On the other hand, if you get a breakout and it starts to fail and you get a reversal, you can, I think it's more okay to trade a little more aggressively on a reversal down, from up here than it is to trade a bull breakout from up here because on the context of the daily chart, it's a little bit more likely that we get some sort of reversal down for at least it'll be minor and it might just be one bar. But what I'm saying is, we're probably not going to get a strong bull trend tomorrow, basically. So I just like to look at the daily chart to have a bias coming into the day as to what I think is going to happen. My two thoughts coming into the day were yesterday on the daily chart was a good buy signal bar, and we were probably going to trade above it. So I thought we would break out above this high, or at least attempt to, and we might get a failed reversal or failed breakout and reversal down from up there. And my other thought was that, if we went down instead of up, the 63 close was probably going to be where the bottom of the trading range was. Why the 63 close? Because I think that's where the trading range started yesterday. You could argue we had a bull trend up through here, but once you get 63, a big bear bar closing near its low, even this is a leg up in a trading range. So when you get legs up in trading ranges, you expect legs down. And the close of 63 is an important magnet for the bears because it was, a huge bear bar. So some bears will sell the close of 63 waiting for the second leg. And, if they sold 63 and they see 64 and they got trapped all the way up, what do you think they're going to be doing when the market gets back to their entry price on bar 7? You think they're going to be looking to sell more because they had the right idea, or do you think they're just going to be looking to buy back their shorts and look for the next trade? Probably going to be looking to buy back their shorts and look for the next trade, which is exactly why we ended up finding buyers at that price. Bar 1, a bear bar closing near its low, but not all that strong. Context-wise, I thought we were probably going to trade above yesterday's high, so it's a low probability high of the day, maybe an okay swing trade. Kind of just a doji bar, followed through on bar 2. It's not really a doji bar. It's a bear bar closing below its midpoint, but it's a pause bar, I think, is what's important. And then big bear bar on 3. So instantly you have 1, pullback, 2, and then 4 is another pullback. So now you have 1 and 3 as legs down and a potential parabolic wedge. So the third push we get down could be the third leg in a parabolic wedge. An inside bar on 5, which is potential final flag, and then a bear bar closing near its low on 6. We did trade above 5, which is not as strong for the bears, but we still have 6 straight bear closes at this point. So it's better to be selling overall than buying. But you have to be worried because you're selling at the bottom of, that there's probably going to be buyers here. So you're selling knowing, your downside is likely very limited, and you're selling a third leg in a potential parabolic wedge. So it's not as good as it could be. And you can see when 7 ended up being a disappointing bar, we had traders buying back shorts, and that's what caused 8 to close on its high. If you were short for any reason, 8, probably a lot of bears are going to be getting out. It's potential expanding triangle here, 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 and here. So 5 points. And bad follow through on 9. You had, when you have 7 straight bear closes, regardless of how good they are, you're probably going to get some sort of second leg down. So probably not going to get a lot of follow through on 8. I'd imagine the traders who sold above the 7 high and are scaling in are going to make money regardless of how good 8 looks. 10 touches the 7 high. So you can see the bears they sold. They scaled in higher all the way up to the top of this sell climax and they got out there. 11 tail on top. So really not all that good. And then a doji bar on 12. Good bull bar on 13, but it's looking like a couple legs up. After 1 through 7, you have to probably be expecting a lower high since it was such a strong move down. So you probably are not going to get above the 1 high on the first bull attempt up. And so that's one of the reasons why a bar like 15 is not a very good buy. It's a big bar with big risk towards the top of a range. And, you're probably not getting up here. So it might be a bit more likely that there are sellers above 15 than there are buyers. It's also a third push, right? 1, pullback, 2, pullback, 3. The second push subdivided into 2 legs with 12 as the subdivision. 16 closing kind of near its low. Some traders might sell it for a second leg down, but it's kind of bothersome that it doesn't close on its low. You're in a tight trading range overall. You're in a 3-bar type trading range, and you're in an overall tight trading range. So selling down here is really not ideal. Bad follow through on 17 as well. So if you took the sell on 16, what did you want to see on 17? Try and envision that next bar. You wanted to see a big bear bar. You want to see something like 63, or even something like 24 with a little bit of a stronger close would have been fine here. But overall, you probably wanted to see a breakout below the 7 low within 1 or 2 bars, and you wanted really good follow through. And you get kind of bad follow through 17, and traders end up exiting on 18, and that's why you get the reversal up 18. Additionally, there were bears who sold during this bar, and they're probably going to be looking to buy back shorts like they are during 18. 18, it's a trend line break. It's double bottom. It's potential major trend reversal. It's an okay swing trade. The problem is 16 and 17 are pretty strong bars, and they're probably going to get a second leg down. And I think, even if we get up to the top of 16, that's the top of the most recent sell climax. So there will probably be sellers up there, and probably sellers around the 15 close, since any bulls who bought that surprise are disappointed with how far down we've gone. So it's most likely that there are sellers around the neckline of the double top, of the double bottom. Follow through for the bulls on 19, but this is a flat moving average too. I think that's another thing is once the moving average is flat, you should really start to consider just sitting out. But good follow through for the bulls on 19, but a tail on the bottom. It's not, it's good enough follow through to keep you in the trade, but it's not amazing. And then 20, shrinking body. So the body is smaller than 19 and a big tail. So again, it's okay to be long, but you're starting to get, rapidly approach resistance. So it's really not as good as it could be. And you're sitting in an area where there's probably going to be sellers, and we're probably going to get a lower high from that. So this is probably a minor reversal is the thing to keep in mind. I don't think bulls ever made 5 points. Yeah, they were not able to make 5 points. But they definitely made 2 to 1 of their true risk. But anyways, 21, a bear bar closing near its low. And bulls know that other bulls will exit below 21. So they buy the close at 21. You can see we got a micro gap up, trying not to let it trigger. And that's a large part of the rally up on 22. 23, a bear bar closing near its low. Do you sell below 23? I think it's, a credible sell. The thing to keep in mind at this point, I think, once you saw 18, you have to be thinking triangle, right? Because even going back to yesterday, this was all just forming a triangle. And, what could it be forming? A bigger wedge, maybe 1, 2, 3. So, on, tomorrow you could argue this was a wedge and bears are going to try and get some sort of lower high, or maybe 4 and then get a swing down. But this is definitely a wedge. But anyways, that's not really that relevant. But overall point being it's a triangle. So if you're selling below 23, we might not get below the 18 low because we've had lower highs and higher lows all day. So that's my big problem. There's also a tail with it right on the bottom of the moving average. There might be more sellers than buyers here, or more buyers than sellers here. But you are towards the top of the range. And you can see bulls scalped with exactly 5 points. So the sell was below 23, probably not below 24. Tail below 24, big risk, probably not getting below 18. So not as good to be selling that low. And, bad follow through 25, relatively expected. And then 26, more bad follow through, probably sellers above 25 though. You can see 26 tested the 23 low. So traders, they sold and, maybe they scalped out and they sold again at that price. And they were again able to make a 5-point scalp. So good for the bears that they were able to make those scalps, but it's limit order bears making money, not stop order bears for the most part, meaning that this is probably going to end up being a more sideways range, but that's relatively obvious considering that it's a triangle. I think once it's a triangle, you probably just sit out. Once you identify the triangle, you probably just sit out. You don't really do anything. You could make an argument. So I'm just going to go through. So I was on bar. I'm going to drop a little. arrow, so I know what bar it was on. I think it was on like 27. I'll go there. But anyways, I think it's really easy to get caught taking sells like 36. It's a tight channel up, but it's a couple pushes up, and you're thinking maybe the breakout's going to start now. But the problem is if you're doing that, you're going to end up taking trades like this, taking trades like this, and you might end up catching it eventually like this. But I think it just makes way more sense to just miss this move up. It's not like an ideal move up. It's okay to buy above 38 because it's always in long. I think we're probably always, if we weren't always in long, we tried to flip to always in short here, but it was never all that clear. And then you get a bull bar closing near its high. So it was never all that clearly always in short, and then you get a bull bar closing near its high. It's probably always in long. And you can buy it for a breakout, but the problem is if you bought above 38, you probably also sold below 36. So it's just kind of difficult to trade within this environment, and I'd rather leave it alone. If you're going to buy above 38, why not wait to see if 39 is a big bull bar? And the obvious argument is because if you waited to buy above a good bull bar, you would have missed the whole move, and that's true. But that's okay. Is this easy trading? You're gonna buy above this and be happy with all of this, and then this? It's really difficult to do. So that's why I just don't think. I think it's okay to pretty much do nothing this entire day. I thought 54 was the best trade of the day, but even that, it's kind of hard to sit through this pullback here. But if you're a true always in trader, you can do it. But I just think that I think that sitting all the way until bar 54 and having done nothing the whole day is completely reasonable. 28 inside bar doji. It's a couple legs down. 7, 18, 27. So maybe some sort of wedge forming, but it's just a triangle. So I'd be careful. 29, a bull bar closing near a tie. 30, follow through. Bad follow through 31, a doji bar, and then outside down 32. So this is just a trading range. And outside up 33, it's an OO pattern. In theory, it's a buy above 33, but I wouldn't take anything here. You can see 34 not able to trigger it. So we have, OIIO. Really, all it means, though, is the market's in breakout mode, and it has been. 35, a bear bar closing near its low. Some traders would sell for the failed OO. 36 closing near its low, below the moving average, but the moving average is flat. It's a couple pushes up. You got this, and then bears want 1, 2, 3 wedge pullback and a measure move down. But the bull channel is pretty tight, so I'm not sure it's a very good sell. And you get bad follow through in 37. If you sell 36, if you're going to take a sell like 36 and then you get 37 as follow through, I think you just have to get out. I don't think it makes a lot of sense to hold short after 37. Just wait and see if 38 is good. And then 38 a bull bar closing near its high. You can bet against a failed wedge essentially, and there's a couple good, and a breakout above the wedge instead of below the wedge. So maybe you want a breakout, a measure move up to here or something, which is actually exactly where we went. What do you know? So we got a measure move up the wedge. Measure moves are everywhere too. If you kind of just take time, I used to be like really obsessed with measured moves because my logic was I could just fade everything and I could pick the exact measured move that the market was going to use if I practiced it enough. And you really can't. They're just profit targets. They're better profit targets than they are areas to fade, but it's still reasonable. It's still they're fun to look at because they make you feel really smart when you can see exactly where the market went, why the market went where it went. But ultimately, if you're buying above 38, the thing that's useful is seeing that this is the wedge and that the measured move target is probably up here, or it might be a more conservative profit target like here. So it could be one of those two. And you can see that's around where we sold off initially, and then we went for the higher one. 39, follow through, but a big tail on the top. 40, another tail. So is this really the follow through you wanted if you bought above 38? No, not really. It's not ideal. 41, a doji bar, but again, really, this is not all that great, and bad follow through on 42. So if you bought and you see is 40, you're 5 bars later, so 4 bars later at 42. Is this really where you wanted the market to be? No, you wanted it to be somewhere way up here. So this is a disappointing breakout so far. And no one's really willing to sell below 41 or 42 though. So you get surprise outside up 43. Traders thinking maybe this is going to be the big breakout, but it really doesn't look all that strong. If you bought for any reason up in here as the market was going up, think about how disappointed you are in the close of 43. It's not all that great. Some traders, you can see 44 was huge because bulls bought the close of 43, just betting it's going to have a second leg. and probably break out to the upside of the 18 bar range. 80% chance we're going to break out to the upside, or 90% chance we're going to break out of the 18 bar range every day. And you can see we broke out to the upside, got a failed breakout of the 18 bar range up here, and then broke out to the downside, which is about, it's pretty rare for that to happen, but it definitely does happen sometimes. 45, doji bar, I think a lot of bulls would just get out below 45. It's really not that great. If you were buying, your thesis was that we're going to get a big, I guess, suppose your premise was that we were going to get a big breakout and maybe try for the all-time high, and you just did not get the follow through. Was that the all-time high, or was it for? No, yeah, it was there. And you just are not getting the follow through that you want. So really not all that great. You can see traders exit. That causes 46. Always in traders would be ready to be out below 46. What part of the problem with trading range days is when you're long in something like this, you can easily get a big sell off that erases any profits you have. So traders are quick to get out. Maybe a point below a bar like 45. 46 closes near its low, but doesn't trigger. Bulls buy the close, and they get a scalp on 47. And bulls buy the close, but there probably weren't many bears willing to sell 46, and they weren't front running it. So when you see 47 closing on its high, bulls, some of them are maybe thinking, oh, well, now we have trapped bears. Maybe we'll get a measure to move up. And then you get 48, right? If you were buying above 47, is 48 what you wanted to see? No, 48 is a pause bar. It's kind of like bar 2. In my opinion, you see 48 and you're kind of just like, okay, well, I don't feel a lot more comfortable with this trade. I don't feel like the probabilities increase that much. It just kind of feels like a very weak follow through bar. So let's see 49. If I buy at 47 and I see 48, my immediate thought is, well, let's see 49. But I think better to just wait, because a lot of times 49 is huge and disappointing, like it was. 50, inside bar, probably buyers below 48 scaling in lower, probably buyers below here scaling in lower. Probably don't buy above 53. You're buying right where these traders bought and got trapped, so it might happen again. And then 54, double top, failed breaker of the 18 bar range. You could argue 1, 2, 3, and it's a bigger wedge, 1, 2, 3, so some sort of nested wedge. Double top high in trading range, pretty good sell, best trade of the day. Sell below 54. Follow through on 55. You can see anyone who bought here, disappointed this, gets out. And big bear bar closing near its low 55. Do you sell 55? Even if you took 54, 55 is kind of a little disappointing. I wanted a bigger bar on 55. It's better than 48 is for 47, but I still am not totally convinced if I see 55. And 56 is even more disappointing. You want to see a bar like 46. You want to see something closing way down here, and ideally get a breakout below the neckline of the double top, and that's when you can start thinking about a big swing. But instead, you get this, which is good, but let's see more follow through. And then 56, an even bigger tail, overlaps with the low of 54. Meaning the traders, if you saw 54 and were too scared to sell it, and you saw 55, you're like, oh gosh, now I'm trapped out. That's not good. 56 gave those traders a chance to get in. That's not a good thing. What you want to see is for it to start to break out to the downside, and the traders who missed the trade have to sell all the way down here, forcing the market lower. Instead, they were able to scale it, or they were able to use a limit order to get in at the same price that you were at a later time. And so it makes it more likely that they might just end up scalping out, and this isn't as strong as they want. That's why you get doji follow through 57, another doji 58, an inside bar 59, and then more or less an outside bar on 60. Just very sideways here. It's 3 pushes up, so it was this, and then essentially a wedge pullback, and then we continued down. But I think kind of hard to sit through that much of a tight trading range. If you sold, you're probably going to be questioning the validity of your premise. But anyways, 60, so 61, essentially wedge pullback, 62 signal bar outside down, 63, but bad follow through since a doji, 64, another doji. Essentially, this is not, it's okay to be short, but it's for a swing for sure. Big bear bar closing near its low 66, around the 43 low, which is where, it's a buy climax. So the bottom of the buy climax is going to find some support. Inside bar 67, essentially second leg down 68, 69. And then if you got out for any reason above 69 or a point or so above 69, so you can sell again below 71, and then you get the big surprise down on 72. And that's sometimes days do that, where they're very sideways all day and everyone's waiting for a breakout. Everyone's looking for a breakout. And then it starts and just everyone gets in too soon and it gets too big. And this is the whole, this is what you were waiting for all day, basically, is the way that I put it. When the market's doing this, you're waiting for a strong breakout to start, because a lot of times you will get a strong breakout. And instead it just does it all in one bar. And then if you miss that bar, you probably just got to be done for the day. But overall, tough day for stop orders. I think that, I thought that 23 was okay, but you probably got to scalp out somewhere down here. 18 is probably fine. You get out below 23, maybe sell. 38 is probably fine, but I just don't want to do anything in here. And I think 54, best trade of the day. Maybe 71, maybe 55. Yeah, that's it. It's just not a great day for stop orders. And I don't trade the first 5 or 6 bars of the day, so I don't count those as credible stops. But probably 1, not the worst. 3, not the worst. But you're going to find buyers down here, so hard to do. And 7, low 1 short with all bear bars. Maybe not the worst thing in the world. On the daily chart, I already discussed that. Probably sellers. Weekly chart, yeah. All right, that's the day.